are Treasury bills a hedge against inflation? I guess the answer to the question is straightforward. Now, don't get me wrong, Treasury bill just have its place as a security. You don't want to be stuck and need funds and not be able to liquidate cash when you need it. Now, what are the differences between the typical Treasury bills that you have in emerging countries like Nigeria and other emerging countries versus the Treasury inflation protected security? Hello everyone and welcome back to my channel. Today I'm going to be answering a question that I have received from a number of people, and that question is, are Treasury bills a hedge against inflation? Now, for a lot of people, if you live in Nigeria, right now we're seeing Treasury bills trend at higher rates, basically in response to a higher MPR rate, right, which is the rate set by the central government that determines what rates will be in the country, determines lending rates, and it also determines the other interest rates in the market. And we see that MPR is right now, as I speak, about 26.75%. And we do know, as at the last auction of Treasury bills, it was at 21%-ish, 20 point something or 21%-ish. Now, we have inflation rates at over 30%, depending on, what statistics you're looking at. Based on all of that, right, I guess the answer to the question is straightforward. Is that really a hedge against inflation? If the inflation rate is higher than the rate you earn on Treasury bills, maybe not. And other things to consider is, look, when you invest in Treasury bills, right, it's a fixed interest rate, usually for a fixed period. Now, if you do the 90-day Treasury bill, 90 days, right, you can, make some quick decisions in 90 days. But remember that the interest rates are annualized. So if they tell you that you earn, say, maybe 15 to 16% on a 90-day Treasury bill, it's a 15% or 16% rate on 12 months, right? And then getting that average for the 12-month period and multiplying that by 90 days. That's really how you get a 90-day return. It doesn't mean you're getting your fixed 15-16% return for a 90-day period. So you have 90-day period Treasury bills, you have 180-day period Treasury bills, you also have 365-day Treasury bills. Now, 365 days is basically a whole year, 12 months, I beg your pardon. So basically what that means is you lock in your funds at a 21% rate for a 12-month period, over which inflation will continue to rise. And even if it stays stable, if it's already trending in the 30s, what does that mean? You're basically losing money. So I guess that answers the question. Is it really a hedge against inflation? Maybe not. Now, don't get me wrong. Treasury bill just have its place as a security. It is low risk. It is liquid, right? And the rates are not bad, right? It's not bad if you need cash flow, right? And so I'm not saying that it's a very wrong investment option to consider. I'm just breaking it down to you to understand. And that's because I got asked the question, is Treasury bill or are Treasury bills a hedge against inflation? And I wanted to give the numbers and the statistics to just demonstrate that maybe they are not a hedge against inflation, but they do have their place in your investment portfolio. Why? Because they are low risk. I mean, if you know what Treasury bills are, maybe that's what I should have started with. But Treasury bills are basically the government, you lending to the government, right? The government comes and says, we would like you to lend us money for a fixed period of time and we will give you this interest rate in return. And what you do is, there are options, right? I know about a couple of years ago, one could, bid directly at the auction with the Central Bank of Nigeria. But right now, you're not allowed to do that right now. Only institutions. And I think it's a minimum of 50 million naira that you're allowed to start your bid at. And is also restricted to institutions. As an individual, you cannot directly go to bid or auction, right? So basically, you are limited in your ability to even get the top interest rate. I am aware that some institutions will actually require that you have 50 to 100 million or even higher for them to get you the max interest rate. Now, if you have lower than that, they would decide if they pull you into a fund with others and bid directly, or they bid directly and then just give it to you and take out a margin. Those are options. But I think you should ask the right questions if you're speaking to your institution, your broker, and say, okay, tell me what my options are. If I have this amount of money, what is the best rate I can get? If not, if I decide to pool with my friends, can I get a better rate? And there are a lot of saving apps these days that offer you the option to lock in your funds at 15 to 18%, which is fair. I know there are apps that even give you 18% with as low as 200,000 naira, right? So you can actually start off with that. But for those that were asking questions and say, I want to invest directly in treasury bills, are they really hedge against inflation? Maybe not, considering all of the statistics that I've shared, but know that they do have their place in your portfolio. Why? They are low risk. 2, liquid. Liquidity is always something you should consider in your portfolio. You don't want to be stuck and need funds and not be able to liquidate cash when you need it, right? I always say that consider maybe, when you're building your safety fund, consider putting it in a mutual fund that invests in treasury bills. There are mutual funds that invest strictly in treasury bills. They're safe, you're not going to lose your money. Or you can even do directly in treasury bills yourself, and then you have the option to liquidate when you do need the cash. Now, that said, I am aware that in the United States, you have the Treasury Inflation Protected Securities, also known as TIPS. Now, if you live in an environment that is, well developed, for instance, what is the average inflation rate in America? It's a lot lower. I think it's between 3 to 5%, if I'm correct. That's the last time I checked. All right. And so if you invest in a TIP, it's adjusted against inflation. Now, what are the differences between the typical treasury bills that you have in emerging countries like Nigeria and other emerging countries versus the Treasury Inflation Protected Security called TIPS that you have in the US? One, the interest rate is fixed for treasury bills in Nigeria, right? But for the TIP, right, it is fixed and it is also adjusted against inflation. Basically, that means as inflation grows, the rate is adjusted against inflation. Then, so in that case, is that a hedge to inflation? Yes. So while the typical treasury bill we have in the emerging market is not a hedge against inflation, the TIPS, Treasury Inflation Protected Security, is and can be considered a hedge against inflation. Why? Because the rates are fixed but are also adjusted against inflation, right? So I wanted to give context because I don't want you to go off with that thinking or that knowledge to say and just go ahead and tell everybody that no, treasury bills are not a hedge against inflation. No, they are Treasury Inflation Protected Securities, right? And in that case, they try to protect you against inflation, so they provide a hedge against inflation. The final thing to consider is the maturity. So for treasury bills, typical treasury bills, short term, 90 days, 180 days, 365 days, basically up to a year, not longer than a year. But with a TIP or TIPS, you have 5, 10, 30 years. Now remember that in that environment, inflation does not spike as high as we have in emerging markets, right? So to a large extent, inflation doesn't go beyond 5%. In fact, the reason why developed countries are experiencing inflation is because post-COVID, there's been a lot of money in circulation and a lot of things just got affected to economies, supply chains post-COVID, right? So typically you find tips for 5 to 10 years or 30 years. And that's because inflation is quite, stable, moving up and down, but it's pretty much stable, maybe 1 or 2 basis points. And also because the treasury bill is adjusted, inflation adjusted, right? So if you're considering investing in treasury bills, make your decisions carefully. Is it a hedge against inflation in an emerging market? Maybe not, right? And not, but do speak to your financial advisor, ask the right questions. If you do live in a developed market, for instance, ask about the Treasury Inflation Protected Security because that is inflation adjusted. Now, if you want to consider what are the other options you have beyond treasury bills, there are other options that can grow with inflation, and I have spoken about that in another video. So click on this video to watch that and find out about other asset classes that grow with inflation that you should consider. See you in the next video, and don't forget to subscribe and share.